Believe it or not, I've been trading for over 12 years and I've both made and lost more money than I'd like to admit. And the main issue that I ran into when I first started trading was finding someone who would actually give me a straight answer to all of my questions. What do I use to trade? What is the best way to trade? How do I even get started in the first place? There was always either no answer or too many answers to choose from that it was practically useless. So in this video, I'm going to give you my straight to the point, no BS guide to trading with all of the answers that I had to find myself through sweat, blood, and tears. Lots of tears. A lot of them. Make sure to like and subscribe if you enjoy the video, and let's get started. Alright, so before you can even get into the charts and the strategies and how to make money and all of this stuff, you gotta understand a few basics, alright? The first question that everybody asks is, how much money do I need to start trading? And the answer is pretty subjective. It depends on you, how much money you have, and how much money you want to make. But for most people, the answer is going to be either $1,000 or as high as $25,000. The reason for this is because if you want to trade a live account, you're going to need at least $25,000 to trade pretty unrestricted. You can definitely trade with less, like $10,000, depending on what you're actually trading, which we're going to talk about in the next question. But for the most part, you're going to want around $25,000 to trade a live account if you expect to make a living, right? If you expect to make a living out of this, you're going to need about $25,000. Realistically, okay? Now, can people trade with less and make more? Yes, but realistically speaking, what are you going to do with $25,000? Are you going to double it in a year? Even if you do, that is $25,000 in profit in a year, right? That's still not really great income, but maybe you can consider that a part-time job, right? So this is just realistically the number that you should use if you are looking to trade a live account unrestricted on your own time. Now, if you want to look for other funding options, you can probably start with around $1,000 because you can use prop firms, which is another thing that we're going to cover in this video. Okay, prop firms allow you to take an evaluation where they basically make you pay a small upfront fee, like let's say $100. Usually it can be a flat rate or a per month cost. And if you pass the evaluation, where you basically just have to trade on a simulation account and pass their rules and get a certain profit target, then they will move you over to a live account, and usually that is around $50,000 to $100,000, okay, depending on what evaluation you choose, okay? So this route is a lot better for beginners, in my opinion, for most people, because you do not need a ton of money. You can practice, you can get some good practice in for, again, not a ton of money, but you actually have some stakes in the game, right? If you pay $100 for this challenge account, you're gonna pretty much treat it like it's a real account, but the end goal and the upside is a $50,000 funded account, right? So that is definitely, in my opinion, the best way to get started is using prop firms. If you want to use prop firms and support the channel at the same time, you can check out the links in the description down below. I have all the prop firms that I use, as well as the best discounts on them. Now, the second question is going to be, what's the best market to trade? There's a ton of things that you can trade, so how do you know which one to choose? Well, if you are available from market open to market close, so that is 9:30 a.m. to around 4 p.m. Eastern Standard Time, if you are available even for just a few hours a day between these two times, okay, you probably want to trade either stocks or what I trade, futures, okay? Now, if you don't have the time, or if you're not even awake for these hours, then you're probably going to want to trade Forex or crypto, okay? Now, the reason for this is because stocks and futures are most active during this time period. This is the New York session, and Forex and crypto can be pretty much active at any time. They're closer to being open 24/7 and active 24/7 than stocks and futures are, okay? So it really just depends on when you're able to trade. In my opinion, what is the easiest to trade is going to be futures and stocks, okay? These are the more predictable markets, in my opinion. Crypto can also be pretty great to trade, but it does definitely take a little bit more skill and experience. And for most beginners, crypto is definitely not the move because most beginners don't know proper risk management and will blow up their accounts on one fell swoop, okay? So futures and stocks probably the best for most beginners. All right, so now that you know how much money you need to actually start trading, you're going to need the software that you require to trade, okay? So what broker or platform should you use, okay? You basically need two things to trade with, a charting platform and a broker. The charting platform is where you do your analysis and make your decisions, and then the broker is where you actually go and execute on that buy or sell that you want to conduct, all right? So for charts, the two best charting platforms in my opinion are TradingView, okay, this is what we're on and using right now, and NinjaTrader, okay. These are like the golden standards for charts, and both of them you can connect your brokers to so that you can trade right here on the charts, okay. Now speaking of brokers, I haven't really been using brokers because I've been using prop firms, but if I were to kind of give my opinion on which brokers are the best, okay, for stocks you probably want to go with someone like Interactive Brokers. For futures, you can actually use NinjaTrader as well. I believe they offer their own futures brokerage. For crypto, BitUnex or Bybit, okay, and for Forex, Oanda. So these are all some pretty good brokers in my opinion. I actually have a promo with BitUnex if you want to get some deposit bonuses and I think lower commissions as well on all your trades. You can again check out the links in the description down below. And then prop firms, which is what I personally use to trade futures with. Okay, there are two that I've currently used, so I'm not going to recommend anyone else because I haven't used them. But Apex Trader Funding and Take Profit Trader, in my opinion, are very solid prop firms. Okay, Apex Trader is the best for the cheapest accounts, so you can get that practice in without spending a lot of money, right? And then Take Profit Trader is a little bit more pricey, but by far the best prop firm, I think, of all of them right now. You can get your payouts very quickly. You can even do 2 payouts in a day. So if let's say you take a profitable trade and then you take your money out and then you take another profitable trade, they'll literally let you request that money out again the same day, okay? So Take Profit Trader is very, very, very good. It's just a little bit more expensive. So for beginners, probably Apex. For a little bit more advanced, probably Take Profit Trader. Now, the question that everybody has on their mind when they first start, right? What's the best strategy for beginners? Usually you're looking up, easiest strategy, easiest trading strategy, simplest trading strategy, okay? And unfortunately, if you have that mindset, it's going to be pretty tough to trade. But luckily for you, I am the simple trader after all, and I do, in fact, have a simple strategy. So I'm going to go over the basics of it right now in this video, but if you want an in-depth breakdown, I'm going to leave a link and a button or whatever to go watch it after you're done watching this video, okay? So come back here and you can watch that later. So let me show you an example of my strategy, and by the way, if you don't even know how to read candlesticks, this is not the video for you. I'm not going to go over how to read candlesticks because I've just done that way too many times. There's plenty of videos out there. It's very simple. Just go learn that really quickly, and then you can come back and kind of understand what we're talking about here, all right? So the strategy that I use and have created is what I call order zones, okay? Now, order zones are two different concepts created by two different people a long, long time ago, put together, and that is supply and demand and liquidity sweeps. Now, it sounds very complicated, but it's very, very simple, okay? All supply and demand is basically an imbalance in the chart, okay? What does an imbalance look like? It usually looks like this, followed by that, okay? And on the other side, it would look like this, followed by that, okay? This is a consolidation, followed by a continuation, and this is what we call a level of supply. This is a consolidation, followed by a sharp continuation, and this is what we call a level of demand, okay? Basically, you're looking for a small point where the market paused for a minute, not exactly a minute, that's metaphorical, and then immediately skyrocketed or tanked from that point, okay? That's why it's called an imbalance, because it was balanced, right? In this point, you're balanced, and then there's an imbalance, right? The buyers and sellers are balanced here, and then there's an imbalance to the sell side. The buyers and sellers are balanced here, and there's an imbalance to the upside, right? So this is what supply and demand is. Don't worry, I'm going to show you what this looks like. And then liquidity sweeps are even simpler, okay? Liquidity sweeps are basically just highs and lows that have stop losses resting above them. Now, how do you know there are stop losses resting above them? You don't. You just have to pretty much pick out really clear highs and lows. Those are the ones that traders are putting their stop losses at, okay? Now, the reason it's called liquidity is because these orders act as liquidity for other traders that are in the market to take the exact opposite trade as the retail traders, okay? So, for example, if you are buying here or here, where are you putting your stop loss? Probably below these lows. If you're betting against the market and you're selling here, or maybe even selling like this, okay, where are you putting your stop loss? You're placing your stop loss above those highs, okay? At least that is what traders are taught to do. Okay, if it goes up here, Okay, they are taught to cut their losses if they are betting that it goes down, and if it goes down below this low, they are taught to cut their losses if they have bought. Okay, now the idea is that price will come into that area, take out those retail traders, stop everyone out, and then go into the intended direction. And same thing on the other side. Okay, we can go up here, take out all those stop losses, and then reverse. Okay, now don't really concern yourself with why this works. All you need to know is that you put the two together and it looks something like this. Okay, first rule obviously is never fight against the trend. Clearly we are moving higher here, so we are only looking to buy the market. This is on the NASDAQ futures. Okay, so let me show you what an order zone looks like. We have a low right here and a level of demand right in here. And again, I have a whole video on this, so if you're a little confused, just go watch that and then come back. All right, so here's our imbalance. We have a consolidation and then a strong continuation to the upside. We have a low, so where stop loss is sitting? Right below that low, right? So we have stop losses sitting in our demand zone. This is what I call an order zone because there are orders sitting in this area. We have orders from the imbalance and we have orders from the low. We have the stop losses being placed below that low. And you can see this trade would have worked out obviously very well. And my stop loss is usually just past the order zone. Okay, give it some room so you don't get, ticked out or whatever. And then you want to target the highs or a level of liquidity. So if you wanted to target these highs here, that would have been fine too. Okay, and that is pretty much my strategy that I use, and it's pretty dang simple in my opinion. So I'm not going to go too much more in depth because we still have a lot to cover, but that is the strategy that I guess I would recommend for beginners. Now, the age-old question, what indicators should I use as a new trader? There are only a few indicators that I use that I've tested and have seen results with in the last 12 years, and I'm going to show you them right now. Okay, so the couple indicators that I use, one is going to be VWAP. Okay, you go to your indicators tab on TradingView, type in VWAP, and it's literally the first one, volume weighted average price. And then what I do is I go to the settings of the VWAP and I make sure I have upper band and lower band number 2 marked out. Okay, this represents 2 standard deviations from the VWAP. VWAP is volume weighted average price. Think of it as like the equilibrium point between buyers and sellers. Okay, that is where the price has traded the most volume. Okay, now the way that you use VWAP is very simple. Okay, if we're above this middle line, you only look to buy, and if we are below this middle line, you only look to sell. If you are below the lower line here, you do not look to sell. Okay, you may even want to look to buy, but you definitely don't want to sell. Okay, so what I'm trying to say here is that this zone right here and this zone right here is where you can trade. Anything outside of those zones, it starts getting a little bit harder to trade. Okay, so you can look for shorts below this middle line and you can look for longs above this middle line. All right, so that is the VWAP and that is how I use it. These will keep you kind of in your lane. Okay, you can see price tends to bounce off the upper level and the lower level. So obviously you don't want to be buying up here and you don't want to be selling down here, right? Now you could look for buying down here and selling up here, but you're going to be counter trend trading and you're going to see probably more losses than winners in my opinion if you start doing that consistently. Okay, it's fine here and there, but from my experience, you want to stick to being in these zones. Okay, so that is VWAP. VWAP basically is used to tell you whether you should be buying or selling in general. It's not going to give you signals, but it's going to tell you, hey, you should be looking for buys, or hey, you should be looking for sells. The second indicator that I use and recommend is going to be the ATR indicator. The ATR indicator stands for average true range, and it basically tells you how much price is moving on any given candle. Okay, so you can see our ATR right here is 7. By the way, if you go to indicators again and just type in ATR, it's the first one, and I have 7 as the input. Okay, you're going to want 7 as your input. You can also use 14, but I personally use 7. Okay, and so what this is doing is it's taking the average amount price is moving from its high to low, right, the range, the average price or the average amount price is moving in these candles for the last 7 candles, and it's spitting out this number, 7.45. So that means that right now the NASDAQ or the micro NASDAQ is moving 7.45 points in either direction on any given candle. Okay, So this is used to usually gauge a stop loss for me. So for example, when I enter a trade, my stop loss is usually 1 ATR, maybe a little bit more than 1 ATR. So if I were to buy right now, my stop loss would be 7 points, around, let's call it 8 points. Okay, and it would look something like that, right? So then that gives me an easy way to tell what my risk is and measure out how much I stand to gain if we were to hit my targets, okay? So ATR is great for using a stop loss that doesn't rely on anything else. It's a stop loss based off of how much price is moving rather than any sort of arbitrary low or high, which, as we know, thanks to liquidity sweeps, are very easy to get touched and then immediately reverse in your direction, right? So you don't want to be putting stop losses below lows and above highs because that's for retail traders, all right? Now let's start getting into risk management. How much should I risk per trade? Well, the answer again depends whether you are using a live account or a prop account, okay? Whether you're using a prop firm or live account. For a live account, you never want to risk more than around 1 to 2%. This has been the golden standard rule forever, okay? 1 to 2% of your entire account, okay? So if you have an $1,000 account, right, you don't want to risk more than $10 per trade, okay? So per trade, you don't want to risk more than $10, all right? That is 1 to 2% of your account, $10 to $20. Now, if you are trading a prop firm account, you may be thinking, well, that is a $50,000 account, 1% of that, okay, that's going to be $500. So I should risk around $500 per trade. No, you don't want to risk $500 per trade, and let me explain why. The reason is because with prop firm accounts, they only give you so much that you can lose before they take away your account, okay? Obviously, they want to manage their risk as well. So if you have a $50,000 account with a prop firm, they don't want you losing $50,000, right? That would cost them a lot of money if it's a live account, right? Because they're giving you the money to trade with. So in order to protect themselves and to protect you, what they do is they give you a maximum drawdown, a max loss. And their max loss for a 50K account is usually anywhere between around $2.5 thousand and $3,000, okay? So if you only have $2,500 or $3,000 to lose before you lose the entire account, how much do you actually have to trade? You have $2,500 to around $3,000, okay? So with prop firm accounts, what you want to do is you want to risk about 10% of your max drawdown, okay? So if you have a $3,000 max drawdown, max loss, you want to risk $300 per trade. If you want to be even more cautious, okay, you want to risk about half that. You want to risk about $150 per trade, or about 5% of your max drawdown. The reason we do this is because we basically want to give ourselves a buffer zone, right? So if you lose 10 trades in a row, then you will hit your $3,000 max drawdown. Well, it's pretty difficult to hit 10 trades in a row, so that's a good buffer. But honestly, what I recommend is using even smaller amounts, or 5% of your drawdown, right? So $150, because that means that you need 20 losing trades in a row to blow up your account, to lose access to your account before you have to buy another one, right? So usually 5 to 10% of your max drawdown is what you want to focus on, and how much you should risk per trade if you are using a prop account. If you're using a live account, the amount is going to be around 1 to 2% per trade. Now, the next question is one that's often asked once you start getting your feet wet a little bit, right? You're starting to go from beginner to intermediate, maybe pre-intermediate, and that is, what's the ideal win rate or risk to reward ratio to be profitable? The answer is very, very complicated, okay? Because it depends on a ton of things. Well, it mainly depends on two things. You obviously have your risk to reward, and then you have your win rate, okay? But you can mix and match these two in an infinite mix of possibilities. So I'm just going to keep the answer very straightforward and simple and tell you from my experience what I've seen has worked for me and for many others. And that is, usually a professional trader and a great trader will have a win rate that is actually less than 50%. I know, shocking, less than 50%. But their average risk to reward is usually 2 to 3 to 1. Okay, so this means they risk $1 to make $2 to $3 or more, okay? So the ideal win rate to risk to reward ratio is going to be a win rate under 50%. Obviously, if you can get better than that, then do it. But usually it's hard to do when you have a risk to reward of 2 to 3 to 1, which again just means that you're risking $1 to earn $2 to $3 or more, okay? So basically, you want a 50% or lower win rate on average. That's what it's usually going to be if you're a good trader. And then you're making, 3x what you're risking or more, okay? So that is usually what very good traders tend to have. And this is excluding break-even trades. This is a very important point because a lot of the times you'll see someone with a 90% win rate, but 9 out of 10 of their trades aren't necessarily a full win. It's just a small profit taken very early or a break even. So let's say, for example, price is moving and you buy right here. It goes up just a little bit, and then you take your stop loss and you move it just above your entry point, okay? If price comes back down here, technically the software that they're trading on will count that as a win and inflate this number. But in reality, it was just a break-even trade, right? They were just breaking even. So usually on average, excluding break-even trades, you're looking at a win rate of under 50%. Okay, then you're going to start wondering, how long does it take to become a consistently profitable trader? And the answer can, again, vary. Trading is very individual, okay? There's no clear-cut, one-and-done kind of answers. But for most people, it is going to take 1 to 2 years to know everything that they need to know to become a profitable trader, okay? Not to become a profitable trader, but to know everything they need to know to become a profitable trader. Why do I say that instead of to actually become a profitable trader? Because what you do with the knowledge that you learn within these 1 to 2 years is how you actually become a profitable trader, okay? Because many people, what ends up happening is that they'll spend 1 to 2 years studying it, but they never master their psychology. They just always think about how much money they can make, how quickly they should take their trades off. Oh, I'm up 10%. Let me just instantly close out this position. Let me just take profits. Nobody's ever gone broke taking profits, right? And this is where you can get stuck for 5 to 10 years, right? But on average, it should probably take, if you are a normal adult, right? So not some teenager. I started trading when I was a teenager, and it took me a very long time, right? Because you're just not very intelligent as a teenager, right? So if you're, I would say 20s to 30s, it should probably take you around 3 to 4 years, just like it does to get your degree, right? People probably think this is way too long, but again, how long does it take for you to get an actual job in the marketplace? With your degree, it takes around 3 to 4 years, right? So just like any other job, it's gonna take a few years. So you have to be ready for that. Now that brings us to our next question, which is, why do most traders fail? Well, we've already covered the psychology and just not being able to get out of your own head and just being greedy all the time, right? That's one reason. But the other reason is that most traders never learn how to properly use risk management, okay? Risk management is the key to everything. So, in my opinion, the reason why most traders fail is because they are not risking 1 to 2% of their live account, or only 5% of their prop firm max drawdown amount, right? Instead, they're risking, let's say, 10 to 20% of their live account. Or on prop firms, it's even worse. Usually, it's 100% of their max drawdown they're risking per trade, okay? If you are trading this way, you have to understand the math of trading, right? If you just lose 4 times in a row and you're risking 25% of your account, right, then you are going to blow up with just 4 losses in a row. The key to trading is making sure that even if you take something like 20 losses in a row, you're still not going to blow your account, okay? And of course, with this, you also need to be making sure that your risk to reward is favorable, okay? So something that I like to teach is dynamic risk to reward, which is you can have a small stop loss, right? I always say 1 to 2 ATR maximum, and you can have, a take profit that is, it doesn't even have to be that crazy. Maybe a 2 to 1 risk to reward or a 3 to 1 risk to reward, okay? But here's where the magic happens. As the price moves in your favor, okay, I always say to just start cutting this stop loss. Bring that stop loss closer to your entry point as quickly as you can. Usually when you are up around 1 to 2 ATR in the upside, okay? Or whatever direction you're betting on, right? Because as you move your stop loss closer and closer to your entry point, you're not only decreasing the amount of risk you have on that particular trade, but you're also dramatically increasing your risk to reward. So for example, if you start at a 3-to-1 risk to reward, but then price goes in your favor and you move this to, let's say half of what you had it, well, now you're going to have a 6-to-1 trade, okay? So if this trade hits and you consistently manage your risk properly, it's going to be very difficult to not win, okay? As long as you're picking decent targets and having proper stop losses, it's going to be hard to lose if you have risk management in place. That is why most traders fail, because they don't have that in place. So now I'm going to show you a live trade example from a couple days ago where I pretty much put all of what I just taught you together, okay? It's the strategy that I teach, it's the risk management that I teach, everything put together into one example, okay? I actually send these levels every morning in the Discord, the key levels that I'm watching, so make sure to join the free Discord down below. You can see I have my levels marked out, and basically I'm looking to buy this because we're in that level of demand and we have just taken out some lows, so we have taken out liquidity, right? So what I'm looking for is basically confirmation that this level is going to hold, which I'm getting right now because we are getting this rejection of these lows, okay? So once I start seeing that, what I'm going to do is look to buy in this gray zone you see right here, okay? So let's skip forward a little bit and see where this actually happens. You can see I get my confirmation here. Now I set my limit order to buy right at this little pullback here. And spoiler alert, it does get hit. So my entry point is this blue line right over here, and my stop loss is this red line right over here. So you can see my stop loss is very, very close to my entry point. It's 1 ATR away. This means I'm not risking too much, but I'm targeting areas of liquidity, which are this previous high right here and this previous high right here. So obviously the distance between here and then here is much, much, much bigger. And you'll see now, I'm going to calculate my risk to reward. Okay, you can see it is about a 2.35 to 1 risk to reward, okay? But what you're going to see is that this trade, as soon as it goes in my favor, as it's starting to right now, I'm going to start moving this stop loss up. So start immediately cutting my risk. Okay, so you can see price is starting to shoot up, and here we go. Now I'm dragging my stop loss and immediately go to a break even pretty much. Okay, so now I'm risking $0 on this trade, and look at how close it came back. It almost got me. It almost stopped me out. Okay, but luckily it doesn't, right? It keeps skyrocketing higher, and that is how you properly manage risk, okay? So I sold one a little bit early. This was actually a mistake on my end. Hey, everybody makes mistakes. It almost came down to my break-even point, but luckily for me, it continues on higher. I sell a little bit more after it breaks through these highs, and my last position gets sold all the way up in here. And by the end of the trade, obviously that was a great risk to reward and a great trade, okay? So that is an example of having a strategy, using good risk management, small stop losses, large targets, moving your stop loss to cut risk, and using the strategy that I showed you in this video. So that is it for this video. Hopefully you enjoyed. If you want to learn how to become a better trader, of course, join the free Discord down below. You can also book a one-on-one coaching call if you really need it. I teach pretty much everything for free on this YouTube channel. So like I mentioned, links to all the prop firms and resources and Discord, everything is down below in the description. Thank you for watching. Smash up that like button. It really helps me, and I'll see you in the next video. Peace.